Welcome back to the Deep Dives, where we sift through your source material and extract the most important nuggets of knowledge and insight. Today, we are undertaking a deep dive into a figure whose name is, well, it's pretty much synonymous with multi-generational wealth creation, Warren Edward Buffett.
Yeah, absolutely. We're looking at the life and legacy of the Oracle of Omaha, an investor and philanthropist who, even as of January 2026, still ranked as the 9th richest person in the world, with a net worth getting close to $150 billion.
And this deep dive is really for anyone who wants to go beyond the headlines. We want to understand how he did it, how his famous investment philosophy changed over time, and some of his really surprising and sometimes contradictory public policy views.
Exactly. We're working from a pretty extensive biographical overview here. It tracks his career all the way from the 1950s right up to the recent news about his succession plan.
And I think the first thing we have to talk about, the thing that frames this whole conversation, is the profound paradox of Warren Buffett.
And that paradox is really the perfect place to start, isn't it? Here you have a person who has built, arguably the greatest non-tech fortune in modern history.
Yeah.
He's been the chairman and CEO of Berkshire Hathaway since 1970. It's this sprawling, massive conglomerate.
But at the same time, he lives this life of personal frugality that just seems impossible for someone of his standing.
It really does. I mean, the sources make a huge point of this. He still lives in the same 5-bedroom stucco house in Omaha, Nebraska that he bought way back in 1958.
For what, $31,000?
For $31,500. So you have this incredible contrast. He is the ultimate capitalist success story, but he's also the ultimate counterexample to that sort of billionaire extravagance we see so often.
And his whole professional life seems to be built on that tension.
It is. He's operating at the absolute peak of global finance, moving billions with a single phone call, but he lives a lifestyle that's more like a successful, small-town business owner.
Okay, so let's unpack that. We have to start at the beginning with part one, the formative years and foundational education. Because the scale of his success is so huge, it's almost easy to forget how early and how meticulously he started.
Oh, absolutely. He was born in 1930. His father, Howard Buffett, was a U.S. congressman. But his drive wasn't political, not in the typical sense. It was purely commercial from day one.
And it started so young. The sources say he was 7 when he read a book called 1,000 Ways to Make $1,000.
That's right. And that title just perfectly encapsulates his entire early mindset. It was all about the numbers, about accumulation.
And he put that into action pretty much right away.
Immediately. He started doing all those classic childhood hustles, selling chewing gum, selling Coca-Cola, weekly magazines door to door. He even worked shifts at his grandfather's grocery store. It was just a constant multi-front effort to bring in cash.
The pinball machine story is the one that really stands out for me, though. It shows he understood more than just earning.
It really does. It's the perfect anecdote. So he's 15, a sophomore in high school, and he and a friend buy a used pinball machine for $25.
And they didn't just put it anywhere.
No, it was strategic. They placed it in a barber shop. Think about it. It's a place with constant foot traffic, and people are just sitting around with nothing to do. It was the perfect location.
And I assume the returns are pretty good.
Spectacular. So good, in fact, that within just a few months, it wasn't just one machine. They had several, spread across 3 different barber shops in Omaha. And in 1947, they sold the whole business.
For how much?
$1,200. On a $25 initial investment, that is a massive return.
And his financial discipline was it was almost obsessive even back then.
Yeah.
I mean, he was delivering the Washington Post, making $175 a month, which was a lot of money for a kid then.
It was. But the detail that blows me away is his first income tax return.
Yeah, tell us about that.
So in 1944, he files his first return, and he claims a $35 deduction for the business use of his bicycle and his watch on his paper route. I mean, think about that. He had a working understanding of business expenses and depreciation before he could even legally drive a car.
So all this hustling and discipline, it actually added up to some serious money.
It really did. By the time he graduated from college, he'd saved up $9,800.
Wow, what is that today? Over $100,000.
Well over $100,000, yeah. And it's not really about the sum itself. It's about the discipline it took to get there so early.
And yet, he didn't even want to go to college, did he?
No, he thought he already knew everything he needed to know about business. But his father overruled him. So he went to Wharton for a bit, then finished up at the University of Nebraska in '51. But the real turning point for him educationally came from a big rejection.
Getting rejected from Harvard Business School.
That was it. That rejection was the catalyst. It pushed him to look at Columbia Business School, but only for one reason. Benjamin Graham taught there.
The author of The Intelligent Investor, the father of value investing.
The one and only. Buffett earned his master's in economics from Columbia in 1951, and that one experience, studying under Graham, gave him the entire intellectual framework for everything that came next.
Okay, so that's the cornerstone. For anyone listening who really wants to grasp the core of this, what were the big, lasting lessons Graham gave him?
Well, Buffett himself says Graham's teachings are the cornerstones of investing even 100 years later. It really boils down to three big ideas. First, and this is the most important one, view stocks as fractional ownership in an actual business, not just as a piece of paper or a blip on a screen. This forces you to think about the business's fundamental value, its earnings, not just the market's mood.
So it's about the business, not the stock price. What's the second idea?
The second is the concept of Mr. Market. Graham personified the stock market as this, manic depressive business partner.
Right.
Every day, Mr. Market shows up and either offers to buy your shares at a ridiculously high price or sell you his at a ridiculously low price. Your job as an investor is to use his emotional swings. You buy when he's panicked and depressed, and you think about selling when he's euphoric.
So volatility isn't a risk, it's an opportunity. That's a huge mental shift.
A huge shift. And the third, and maybe the most famous lesson, is the margin of safety.
The protective buffer.
Exactly. Graham taught that you have to buy a business for significantly less than its intrinsic value. So if a business is worth $1, you should aim to buy it for, say, 60 cents. That 40-cent difference is your margin of safety. It protects you if you're wrong, if the economy turns, if anything unexpected happens. It's your single best defense against losing money permanently.
It sounds so simple in theory, but I imagine it's incredibly hard to practice. And Buffett didn't immediately go to work for Graham, did he?
No, he struggled to land a job with his mentor. He even offered to work for Graham for free.
And Graham said no.
Graham refused. At the time, Graham had a practice of hiring Jewish analysts because they were often discriminated against on Wall Street, so he passed on Buffett. Buffett had to go back home to Omaha.
And that's when he started working as a stockbroker and teaching night classes.
Yeah, which is kind of ironic, isn't it? He's a 21-year-old kid teaching these investing principles he just learned from Graham to students who are often twice his age.
But the opportunity to work with Graham finally came through.
It did, in 1954. He got a job as a securities analyst at Graham Newman Corp for $12,000 a year. He worked there for 2 really crucial years, side by side with Walter Schloss, another one of Graham's famous disciples.
So when Graham retired in 1956, Buffett was ready.
He was perfectly positioned. Graham closed his partnership. Buffett took his own savings, which by then was up to $174,000, and armed with this perfect intellectual framework, he went back to Omaha one last time, this time to start his own investment partnerships.
And that really sets the stage perfectly for part 2, the evolution of Berkshire Hathaway. This is where he goes from being a student of Graham's rules to a master who eventually kind of transcends them.
He started Buffett Partnership Ltd. in 1956, and by 1962, he was already a millionaire. The partnerships were managing about $7.2 million, and over $1 million of that was his own money.
And this early period was just textbook Graham.
Right.
Finding super cheap assets.
Pure textbook Graham. Finding businesses that were just fundamentally cheap, often without much regard for the quality of the business itself. It was all about the numbers.
And the Sanborn Map Company investment is the ultimate example of this.
Oh, it's the perfect case study. Sanborn Map Company made these incredibly detailed maps for the fire insurance industry. But by the 60s, that business was becoming obsolete.
But the company had something else on its books.
It did. Over decades, it had built up this massive investment portfolio of stocks and bonds, and the market just completely ignored it.
So what was the math?
The math was incredible. Buffett found that Sanborn's stock was trading at $45 a share. But the value of its investment portfolio, which could be easily sold, was worth $65 a share.
So you were paying $45 for $65 of liquid assets.
Exactly. Which meant the market was valuing the actual map-making business at minus $20 per share. You were literally being paid $20 to take the business for free.
That's the margin of safety in action. So how did he get that value out?
He became an activist. He started buying up shares, got to 23% of the company, and then he demanded a seat on the board. He allied with other shareholders who were also frustrated and basically forced management to use the investment portfolio to buy back shares at their fair value.
And the result was a 50% return in just 2 years. It's a perfect example of what he called cigar butt investing.
The ultimate cigar butt. You find one on the ground, there's one free puff left in it. You take the puff and you throw it away. You're getting one last puff of profit from a dying business.
Which is so different from what he would later become famous for. And that brings us to the great irony of his entire career,
Berkshire Hathaway itself.
which he calls his worst trade.
He does. He took control of the textile manufacturer Berkshire Hathaway in 1965. He was drawn in by the cheap valuation, but the American textile industry was in a death spiral because of foreign competition. He later admitted he kind of got into it emotionally after a dispute with the old management. The last textile mill was finally sold in 1985.
But the genius wasn't in the textiles. It was in what he did with the company itself.
That's the masterstroke of capital allocation. Instead of just liquidating it, he kept the corporate shell. And he used the capital the business was generating, small as it was, to pivot into a totally different industry, insurance.
And the insurance business gave him the float.
That's the magic ingredient. The float is all the premiums customers pay up front, which the insurance company gets to hold and invest for its own benefit before it has to pay out any claims. That float provided a stable, massive, and continuous source of capital that funded all of his legendary investments for decades to come.
So that shift in the 70s and 80s led to some iconic acquisitions. The Washington Post was an early one.
Yeah, the Washington Post in 1973 was a key moment. It showed him starting to invest based on the quality of a business and its management. He became very close friends with its leader, Katharine Graham. Then in 77, he bought the Buffalo Evening News, which was a much more aggressive move. It actually led to antitrust charges until the rival paper went out of business. It showed he could play hardball.
But the deal that really showed his new role as a financial stabilizing force was Capital Cities ABC in 1985.
That was a masterclass. Capital Cities was a smaller company trying to buy the much larger ABC network for $3.5 billion. Buffett came in and helped finance the whole thing, getting a 25% stake in the combined company in return. It showed he was willing to be a powerful but passive partner if he trusted the management.
And his ability to step into a crisis was really tested a few years later with Salomon Inc.
Oh, the Salomon scandal in the early 90s was an existential threat to one of Wall Street's biggest firms. Berkshire was the largest shareholder with a 12% stake, and Buffett was on the board.
What was the scandal exactly?
A rogue trader, Paul Moser, had been submitting illegal bids in U.S. Treasury auctions. It was a massive breach of market rules.
And the CEO, John Gutfreund, didn't handle it well.
Not at all. He found out about it but didn't report it to regulators immediately. That cover-up threatened to get Salomon barred from the Treasury market entirely, which would have destroyed the firm. The government was ready to shut them down.
So Buffett had to step in, which was a huge risk to his own reputation.
An immense risk. He became the interim chairman. He came in and immediately imposed total transparency and a zero-tolerance policy for ethical breaches. His personal reputation for integrity was the only thing that convinced regulators to give the firm a second chance. He stabilized it and protected his investment.
But if we're talking about pure investment returns, the defining deal of that whole era has to be Coca-Cola.
Absolutely. In 1988, he started buying Coke. He ended up with 7% of the company for just over $1 billion. And this was not a Sanborn map cigar butt. This was a world-class business with a powerful brand, incredible pricing power, and a durable competitive advantage. This was the moment that really cemented his shift to buying quality.
Now, moving into the 21st century, it wasn't always smooth sailing. The General Re acquisition in 1998 caused some major problems.
Yeah, Gen Re had two big issues. First, their underwriting standards were pretty poor, which led to big losses. But second, and maybe more damaging, was what they called a problematic derivatives book.
Can you break that down for us? What does that mean?
So a derivative is a financial contract whose value is based on an underlying asset, like a stock or currency. They can be incredibly complex and leveraged. Gen Re had this huge, tangled portfolio of these things that exposed Berkshire to massive, hard-to-predict risks. It was exactly the kind of complex finance that Buffett usually avoided.
And the fallout from that went beyond just money, right? It dragged Berkshire into a huge accounting scandal.
It did. Gen Re executives were implicated in the AIG accounting fraud scandal, which was one of the biggest of the decade. It actually forced AIG's legendary CEO, Hank Greenberg, to resign. In the end, Genry had to settle with the government for $92 million. It was a real black eye and a reminder that even the oracle can make a huge misjudgment.
And yet, around the same time, he was making these huge, shrewd bets that paid off beautifully, like his bet against the US dollar.
That showed his macro thinking. In 2002, he became very bearish on the US dollar. He entered into $11 billion worth of contracts betting against it. It was a massive currency speculation, and by 2006, he'd made over $2 billion from it. It proved he could handle complexity, but only when the underlying idea was simple enough for him to understand completely.
That's a perfect transition to part 3, where we really nail down this investment philosophy, how he moved from buying cigar butts to businesses you hold forever.
This evolution is really the whole intellectual story of his career. Like we said, he started with pure gram, finding those cheap stocks where the quality of the business almost didn't matter. It was just a numbers game.
But that strategy has its limits, especially when you're managing billions of dollars. You can't just buy tiny failing companies anymore. And this is where his partner, Charlie Munger, had a huge influence.
Munger is absolutely critical to this story. He's credited with really shifting Buffett's thinking. Munger's famous line is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
So the focus shifted to what they called durable competitive stocks. What does that actually mean in practice?
They call it a moat, a business's moat. And they look for a few key things. Strong brand loyalty, like you see with Coca-Cola. Strong, consistent, and predictable earnings. A real competitive advantage. Something that's hard for anyone else to copy. And most importantly, pricing power.
The ability to raise prices without losing customers.
That's the ultimate test of a great business. If you have pricing power, you have a durable advantage.
And this new focus on quality meant he had to change his time frame, too. It led to the idea that the best holding period for a stock is forever.
It's the only logical conclusion, right? If you own a piece of a truly wonderful business that's compounding its value year after year, why would you ever sell it? He summed it up in '96. He said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Short-term price moves are just noise.
And all of this is built on his 2 famous rules.
Rule number 1, never lose money. And rule number 2, never forget rule number 1. Now, obviously, that's not literal. He's had losing investments. But it's about a mindset. It's about making the preservation of your capital the absolute top priority before you even think about returns.
He also had a really pointed warning about inflation, calling it a kind of hidden tax.
Yeah, he said inflation is a far more devastating tax than any law Congress could pass. And it makes sense, right? Income taxes take a percentage of your earnings. Inflation eats away at the purchasing power of your actual capital. It's a silent destroyer of wealth, especially for people on fixed incomes.
So his belief that he could consistently beat the market put him in direct opposition to the big academic theory, the efficient market hypothesis.
Right, the efficient market hypothesis basically says you can't beat the market over time except by luck because all information is already priced into stocks. Buffett thought that was just nonsense.
And he actually set out to prove it was nonsense.
He did. He wrote an essay called The Super Investors of Graham and Doddsville. In it, he tracked the records of a bunch of different investors, people like Walter Schloss and Charlie Munger, who all came from the Ben Graham school of thought. And he showed that they all consistently beat the market averages for decades. It wasn't luck. It was a shared, disciplined philosophy.
Okay, so here's the big contradiction then. If he believes so strongly that active management works, why is he such a famous and vocal advocate for low-cost S&P 500 index funds for the average person?
That's the billion-dollar question, isn't it? And the answer is pure pragmatism. He believes active management can work for him and for a very small number of other highly disciplined people. But for the vast majority of investors, he thinks they just don't have the time or, more importantly, the emotional temperament to do it properly.
And he thinks the financial industry is basically set up to take advantage of them if they try.
100%. He's incredibly skeptical of Wall Street's high fees. He believes that when you have trillions of dollars being managed by people charging 2% a year plus performance fees, the only people guaranteed to get rich are the managers, not the clients. The fees just eat away at all the returns.
Which is what led to his famous bet against hedge funds.
The famous bet from 2007. He wagered that a simple, boring, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years, and by 2017, it wasn't even close. The simple index fund won decisively. It proved his point that for most people, Fees and complexity are the enemy.
Let's pivot to a couple of assets he famously disliked: gold and technology. Why was he so critical of gold?
Because his entire philosophy is based on owning productive assets, businesses that generate cash and reinvest it to grow. Gold doesn't do that. It's not productive.
Right, he had that famous quote about it.
He did. In 1998, he said, "It gets dug out of the ground in Africa, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility." His point is that it's an inert asset. Its value is based purely on what someone else will pay for it tomorrow, not on what it produces.
And that same logic explains why he stayed away from tech companies for so long.
Exactly. His number one rule is never invest in a business you cannot understand. For years, he felt that tech companies were just too complex, and it was impossible to confidently predict what their earnings or competitive position would be 10 or 20 years out. It was outside his circle of competence, so he stayed away.
But then came the big surprise. In 2011, he bought IBM.
A huge shock to everyone. He invested $11 billion in IBM, and his justification was fascinating. He said he wasn't buying it for the complex technology. He was buying it because he'd studied how sticky their corporate clients were. He saw their customer retention as a powerful, understandable moat, even if he didn't understand every line of code.
It showed he could adapt. But on the next wave of technology, cryptocurrencies, he went right back to his old skepticism.
Oh, with a vengeance. He's been completely uncompromising on Bitcoin. He called it rat poison squared. He thinks, much like gold, it's a non-productive asset with no intrinsic value. He has predicted over and over again that it will come to a bad ending. It just fails every single one of his fundamental investing tests.
Okay, let's move into part 4 and look at his leadership during a moment of true systemic crisis: the Great Recession in 2007 and 2008.
That was a brutal time, even for Berkshire. Their earnings fell by 77% in the third quarter of 2008 alone. The market was genuinely worried about their exposure to the financial sector.
But his response wasn't just to manage his portfolio, it was very public.
It was. He sort of took on the role of cheerleader-in-chief for the American economy. He wrote that famous op-ed for the New York Times in October 2008 called "Buy American, I Am." At a moment of peak panic, he was publicly putting his money and his reputation on the line, signaling his confidence in the country's long-term future.
And he was putting real capital to work, too, in some very instrumental deals, like the Goldman Sachs investment.
That Goldman deal was a classic Buffett move. He didn't just buy common stock. He bought 10% perpetual preferred stock. It paid a massive 10% annual dividend, and it gave him warrants to buy common stock cheaply later. It was a fantastic safe deal for Berkshire, and for Goldman, it was a desperately needed injection of cash and, more importantly, a stamp of approval from the Oracle himself.
He did something similar for Dow Chemical, right?
Yes, he provided $3 billion to help Dow finance its takeover of Rohm and Haas. At that point in late 2008, credit markets were completely frozen. Capital was impossible to find. Buffett's involvement was a sign of stability in a sea of chaos.
Now, we talked about derivatives before. His own company had some major exposure to them that led to some huge paper losses during the crisis.
This is a really interesting point. Berkshire had sold a lot of put options, which is basically a bet that the market won't crash. They collected the premium up front. But when the market did crash, they were suddenly facing enormous potential liabilities.
How big were the losses?
By late 2008, the mark-to-market losses on those contracts were running at about $6.7 billion. The potential liability was so big that the SEC actually stepped in and demanded that Berkshire provide more robust disclosure about how they were valuing these complex long-term contracts.
It just shows the level of risk, even for someone so focused on safety. And he was also willing to admit when he just made a flat-out mistake, like with ConocoPhillips.
The ConocoPhillips investment is a great lesson in humility. He'd bought a huge stake in the oil company when energy prices were near their peak. He later told shareholders that his decision to sell a large part of it at a loss was dead wrong and cost Berkshire several $billion. He took full responsibility.
But at the same time, he was making his biggest acquisition ever, buying the BNSF Railroad.
Right. The Burlington Northern Santa Fe acquisition in 2009 for $34 billion. That was a game changer. It was the ultimate forever holding. Railroads are essential infrastructure. They have an incredible competitive moat because you can't just go out and build a new railroad. It diversified Berkshire into the physical economy, away from the volatility of finance.
And by the middle of the next decade, all these moves were paying off in a huge way.
A huge way. In the second quarter of 2014, Berkshire posted its biggest quarterly profit ever, $6.4 billion. And that August, the Class A stock price crossed $200,000 a share for the very first time.
That financial strength brings us to the more recent history, particularly the long-awaited succession plan.
Yeah, succession was the big question for decades, and the plan finally came into focus. He'd been talking about it since 2007, but at the 2025 investor meeting, he made it official. He asked the board to name Greg Abel, who runs all the non-insurance businesses, as the new CEO.
And that transition happened at the start of 2026.
Correct. Abel became president and CEO on January 1st, 2026. Buffett stayed on as chairman, still overseeing the big capital allocation decisions, but it marked the beginning of a new era.
But just before that, in 2023, a report came out that raised some tough questions about his personal trading activities.
Right. A ProPublica article based on leaked IRS data alleged that between 2009 and 2012, Buffett made about $80 million in personal trades in stocks like Johnson & Johnson and Wells Fargo, at the same time that Berkshire itself was trading in those sectors.
The implication being a potential conflict of interest.
Exactly. It raises questions about whether he was acting on privileged information. Now, Buffett himself didn't comment, but Charlie Munger defended him fiercely, saying there was not the slightest chance he was doing anything unethical. But it does highlight the complex issues that arise when a CEO is also a major personal investor.
That tension between the public figure and the private man is a perfect segue to Part 5. Frugality, family, and his radical approach to philanthropy.
It's just such a core part of his story. We know about the house. But his salary has always been tiny for a CEO of his stature, around $100,000 a year in the mid-2000s. He drives his own car, eats McDonald's. It's almost like a performance.
But there's one famous exception to the frugality: the private jet.
Ah, yes, the private jet. It's a great story. He had spent years criticizing CEOs for corporate excess, especially private jets. But in 1989, Berkshire bought one, and he cheekily named it the Indefensible.
But he later renamed it the Indispensable. What changed?
Reality and scale. As Berkshire became this global behemoth, his time became the company's most valuable asset. Flying commercial was just too inefficient. The name change was his way of admitting that sometimes what looks like an extravagance is actually a necessity for operating at that level.
His resistance to technology has also been legendary.
Oh, for decades, he was a digital hermit. In 2006, no cell phone, no computer on his desk. As late as 2013, he was still using an old Nokia flip phone and bragged that he'd only ever sent one email in his life. To Jamie Dimon, the CEO of JP Morgan, he finally upgraded to an iPhone in 2020. But his habits are still very analog. He reads 5 newspapers, physical newspapers, every single day.
His personal life has also been, let's say, unconventional. The relationship with his wife Susan and his longtime companion Astrid Manx.
It was a very unique arrangement. He married Susan Thompson in 1952, and they had 3 kids. But in 1977, they started living apart, though they never divorced. She passed away in 2004, but his companion, Astrid Manx, had lived with him since 1977 with Susan's full knowledge and blessing.
The Christmas cards were the famous proof of this.
Yes, for years, a family Christmas card was signed Warren, Susie, and Astrid. It speaks to this very long-term, pragmatic, and respectful approach to relationships that, in a way, mirrors his business philosophy. He married Astrid in 2006.
And his views on what he'll leave to his children are just as unique.
He's been very clear that his kids will not inherit the bulk of his fortune. And his reasoning is famous. He said, "I want to give my kids just enough so that they would feel that they could do anything, but not so much that they would feel like doing nothing."
He's giving them a head start, not a free ride. Which brings us to the absolutely unprecedented scale of his philanthropy and the giving pledge.
The scale is just staggering. He has pledged to give away 99% of his wealth. The biggest piece of that went to the Bill and Melinda Gates Foundation. In 2006, he made what was then the largest charitable donation in history, 10 million Berkshire shares.
And that gift came with some specific rules, didn't it?
It did. Very smart rules. 1, either Bill or Melinda Gates has to be alive and active at the foundation. 2, it has to remain a charity. And 3, this is the crucial one, the foundation has to spend the value of his gift every year, plus 5% of its own assets.
So the money can't just sit in an endowment forever. It has to be put to work.
It has to be deployed. He doesn't want to create a permanent, ever-growing pool of capital. He wants it spent. And he's also given billions to his own children's foundations. As of mid-2025, his total giving was already over $60 billion.
Wow. Okay, that sets us up perfectly for our final section, part 6. His public policy views. This is where that tension we talked about at the beginning, the frugal billionaire, really comes to a head.
It really does. And his views on taxes are probably the most shocking to people, coming from someone who benefited so much from the system. It all blew up with his class warfare quote in 2006.
Remind us of the numbers he was talking about.
He pointed out that his own federal tax rate was only 19%. The reason was that most of his income came from capital gains and dividends, which are taxed at a much lower rate. Meanwhile, his employees, who earned salaries, were paying an average of 33%.
He thought that was just fundamentally unfair.
He called it out directly. He said, there's class warfare, all right, but it's my class, the rich class, that's making war and we're winning. That single statement that he was paying a lower tax rate than his secretary led to the whole debate around the Buffett rule.
And he's also a big defender of the estate tax or the inheritance tax.
A huge defender, which is very unusual for someone in his position. He sees it as a tool to prevent the creation of a permanent aristocracy of wealth. He believes in meritocracy, and he thinks just passing down massive fortunes from generation to generation stifles that.
He's the great analogy for it.
A brilliant analogy. He said getting rid of the estate tax would be like picking the 2020 Olympic team by just choosing the eldest sons of the guys who won gold medals in 2000. It makes no sense in sports, and he believes it makes no sense for the economy either.
Beyond taxes, he's also been a really sharp critic of the U.S. healthcare system.
He calls U.S. healthcare costs an economic tapeworm. He argues that the enormous cost of providing healthcare to employees makes American manufacturing completely uncompetitive on the global stage. We spend 17% of our GDP on healthcare, way more than other countries, and often get worse outcomes.
And he blames the incentives in the system.
He specifically calls out the fee-for-service model, where doctors and hospitals get paid for doing more procedures, not for making people healthier. He thinks it creates a powerful incentive for overtreatment and unnecessary care, which just drives costs through the roof.
And finally, his political engagement. He's a Democrat.
A lifelong Democrat.
Yeah.
He's been a vocal supporter of candidates like Barack Obama and Hillary Clinton. And he's very concerned about things like population growth, which is why his foundation has given over $1.5 billion to family planning and reproductive health, including hundreds of millions to Planned Parenthood.
And he really put himself in the political arena in 2016 when he challenged Donald Trump on his tax returns.
That was a fascinating moment. Trump's excuse for not releasing his returns was that he was under audit. So Buffett just called his bluff. He released his own tax returns for 2015 and said, look, I'm audited all the time. There's no law that says you can't release them. It was a direct challenge, using his own reputation for transparency as a political tool.
That really brings everything full circle. The investor, the man, the political advocate, they're all connected. So let's try to boil this all down. What are the key takeaways you should remember?
I'd say remember the childhood pinball empire, which showed his early grasp of compounding. Remember the jet, changing from the indefensible to the indispensable, which shows how he adapted to scale. Remember his bet on the simple S&P 500 fund, which shows his pragmatism. And of course, the $60 billion commitment to give his wealth away.
In terms of his philosophy, it's that synthesis. He started with Ben Graham's cigar butts, buying cheap things, and evolved, with Charlie Munger's help, to buying wonderful businesses to hold forever.
That's the whole intellectual journey right there, from cheap stocks to great companies. But I think the most important thing to leave with is that profound tension that we started with.
The tension between how he made his money and how he thinks it should be distributed.
Exactly. On one hand, he believes the market economy is the greatest engine for prosperity ever created. It rewards genius and hard work with outsized returns, like his own nearly $150 billion fortune.
But at the same time,
At the very same time, he argues that this system creates unacceptable levels of inequality. So he fiercely advocates for higher taxes on the rich, for the estate tax, and then he personally commits $60 billion to counteract the very outcomes of the system that made him wealthy in the first place.
which leaves us with a really big, provocative question to end on.
It's the central question of modern capitalism, and Buffett embodies it perfectly. How should a society reconcile the creation of these massive fortunes, which clearly drive innovation and productivity, with the ethical responsibility to redistribute that wealth so that society remains fair and stable? And how do you do that without killing the incentives that created the wealth in the first place?
That is the puzzle, a fantastic thought to end on. Thank you for walking us through the life and the many contradictions of the Oracle of Omaha.